Before we start, let's talk about why this course matters. Real estate is the largest asset class in the world. Unlike stocks, you can touch it, improve it, and rent it out. Banks finance most of the deal, so your equity earns the full return. Rent comes in every month, independent of stock market swings. By the end of this course, you'll speak the language professionals use: NOI, NPV, IRR, DSCR, and you'll be able to underwrite any deal from rent roll to final return. Let's begin. This page shows the reference rates used throughout the course. The currency peg, the risk-free rate of around 4 to 4.5%, residential mortgages capped at 70 to 75% loan-to-value, the corporate tax of 10%, and the transfer fee of 0.25%. Below is the full course map, 14 modules from market basics, time value of money, returns and risk, all the way through portfolio theory, real options, and the Capstone Tower project, plus a 40-question final exam. This page covers 3 foundational topics: the real estate cycle, with 4 phases: recovery, expansion, hypersupply, and recession; the 3 ways to value a property: sales comparison, income capitalization, and replacement cost; and the magic and danger of leverage. The example shows how a $1 million property with $200,000 down earns the full assets appreciation, but if values fall 10%, your equity loss is amplified. Leverage cuts both ways. This page is Lesson 0.4, Approximate Market Benchmarks. The table compares typical rent and cap rate ranges across sectors: prime Grade A office, Grade B office, prime residential, suburban residential, retail, and warehouse logistics. Cap rates run from about 5.5% for prime residential up to 10% for warehouses. Then the Module 0 quiz tests you on which district is the future central business district, transfer fees, foreign ownership rules, and personal income tax. This page covers Try It 1.1, then Lesson 1.3 on annuities. The 2 formulas you must memorize: future value of an annuity and present value of an annuity. A worked example values a 5-year villa lease at $480,000 per year. Then Try It 1.2 and Lesson 1.4, perpetuities. The perpetuity formula is simply cash flow divided by the discount rate. Used directly in cap rate valuation, it's the simplest way to value a stable income stream. This page is Module 2, Returns and Risk. Learning objectives include computing simple and compound returns, building a price index, and decomposing total return. Lesson 2.1, The Simple Holding Period Return Formula. Total return equals income return plus capital return. A worked example computes a 1-year apartment return. Then Lesson 2.2 builds a price index from the growth rate, with another worked example. This is how you measure historical performance. This page extends to worked example 2.d, 2 apartments compared using arithmetic time-weighted return. The table shows yearly returns for property X and Y. Then Lesson 2.4, Expected Return, the probability-weighted average of all possible outcomes. Worked example 2.f walks through property X with 3 scenarios: recession, normal, and boom, each with assigned probabilities and returns. The expected return computation is shown step by step. This page continues the variance and standard deviation calculation for property X, finishing at 10%. Then property Y at 20%. Lesson 2.5, Standard Deviation. Quick check Q1.1. Worked example 2.g compares the 2 assets. Then Lesson 2.6 introduces the ex-ante versus ex-post risk premium distinction. Ex-ante is what you expect before the dice roll. Ex-post is what actually happened. This page is Module 3, Income, Expenses, and net operating income. Learning objectives: build a property pro forma, identify gross income, operating expenses, and reserves, and reach NOI. Lesson 3.1: The pro forma stack. Lesson 3.2 lists typical operating expense line items: security, utilities, repairs, insurance, and management. Then worked example 3. Starts a West Bay office floor pro forma showing potential gross income, additional revenue, and expense detail. This page completes the West Bay office NOI calculation. Vacancy at 7% removes $10,500 from gross, giving effective gross income of $139,500. Operating expenses include the Pearl fee, insurance, and management. Reserves at 3%. Final NOI is $115,140. This is the central operating number every valuation tool uses as input. This page is Lesson 4.3, Vacancy Rate and Effective Rent Formulas. Vacancy is empty space divided by total stock. Effective rent is asking rent times lease length minus free months, divided by lease length. A static example shows 50,000 square meters total with 3,500 vacant. So vacancy is 7%. Then Lesson 4.4 covers major space market indicators: vacancy rate, market rent, new construction, absorption rate. Module 4 quiz follows. This page is Lesson 5.3, Why cap rates vary across markets. Cap rate equals NOI divided by value, but it's also driven by risk, growth expectations, and interest rates. A try it practice asks you to compute the cap rate given specific NOI and value. Then Module 5 quiz with 3 short questions on the decision rule for NOI, when cap rate is the right tool, and how cap rates interact with growth. This page is Module 6, NPV, DCF, and IRR, the investment decision tools. Learning objectives include computing NPV from a multi-period cash flow stream, applying the NPV decision rule, and computing IRR. Lesson 6.1, NPV, the wealth yardstick. The decision rule is, except if NPV is positive. Worked example 6. Walks through an Al-Sad retail acquisition with multi-year discounted cash flows, ending with a positive NPV of $944,000. Except. This page is Try It 1.1 and Lesson 1.4, the hurdle rate IRR check. Compare the deal IRR to the hurdle rate. If IRR exceeds hurdle, accept. If not, reject. Lesson 1.5 covers when IRR and NPV disagree. The rule is always trust NPV, because IRR can mislead with non-conventional cash flows. The page closes with the start of Module 1 quiz, Decision Rules for NPV and IRR. This page is Module 7, Discounted Cash Flow Valuation. Learning objectives: build a multi-period operating forecast, compute the reversion cash flow, and reconcile NPV with cap rate. Lesson 7.1, the DCF equation. Value equals the sum of all cash flows discounted to today. The worked example builds a Lusail office tower from year 1 operating cash flow, layered with reversion at sale, ending with the total enterprise value. This page is Module 8, Mortgages, Debt Service, and DSCR. Learning objectives include computing monthly payments and remaining balance. Lesson 8.1, Loan Mechanics. The level payment formula gives monthly principal and interest. Annual debt service equals payment times 12. Balance at any time uses the same formula. Worked example 8.A computes a Lusail apartment loan. 8.B finds the balance after 5 years. Then Lesson 8.2, DSCR, NOI divided by annual debt service. This page is the side-by-side comparison of 3 mortgage types: Interest only with no principal until end. Constant amortization with level principal payments. And constant payment, the most common, where monthly payment is fixed. The table shows the difference in monthly payment, total interest, and balance behavior. Lesson 8.3 follows on default and foreclosure priority. The best for column tells you which type fits which borrower. This page is Module 9, Leverage, WACC, and Levered Returns. Lesson 9.1, the vocabulary. Value equals loan plus equity. LTV equals loan over value. Worked example 9A on a 35 million property. Lesson 9.2, leverage reshapes risk and return. Levered return equals unlevered return plus a multiple times the spread between unlevered return and cost of debt. Worked example 9.B is positive leverage. 9.C is the warning case of negative leverage. This page is worked example 9.F, the WACC identity check at 60% loan-to-value. Equity returns equal weighted average return crossed against cost of debt. Component-by-component leverage formulas show how each piece flows through. Lesson 9.5 distinguishes positive, neutral, and negative leverage. Try it practice tests the formulas. Module 9 quiz with multiple short questions on cost of debt, equity multiple, and leverage outcome. This page is Module 10, Commercial Mortgage Underwriting. The setup: you are an underwriter at Qgate Capital reviewing a 45 million real loan request. The 4 underwriting criteria are listed. Maximum loan-to-value of 75%. Minimum DSCR of 1.2. Maximum break-even ratio of 85%. Capital improvements considered. Then lease information, 10-year lease. Question 1 walks through loan-to-value, the loan amount divided by appraised value. This page is question 4, the equity before tax cash flow test. The formula EBTCF equals NOI minus debt service minus capital improvement. The pass test requires EBTCF positive every year. The table shows years 1 through 10, with EBTCF figures by lease period. Year 10 with the capital improvement applied is negative. Underwriting decision: approve the loan but condition the approval on a CI reserve account. This page closes Module 11 with sources of U.S. benchmark data, NFIODC for open-end core funds, Cambridge Associates for opportunistic funds. The GCC has no native NCREF, so investors use MSCI real estate or build proprietary peer groups. Then Module 11 quiz: why diversification works, what style purity means, computing the Sharpe ratio, defining the tangency portfolio, and naming the standard U.S. institutional benchmark, CREF NPI. This page is Module 12, Simplified Financial Feasibility Analysis. 2 procedures shown. Total project cost equals land plus hard cost plus soft cost. Profit margin is profit divided by total cost. The page works through a numerical example showing the project margin. Then Lesson 12.2 lists the simplified financial feasibility shortcomings. Single period snapshot. Ignores time value of money during construction. Uses 1 cap rate. Ignores leverage cost. This page works the 4 construction draw schedule. For million paid at month 0, 3, 6, and 9. The table shows the present value of each draw at the cost of construction rate. Capitalized interest is the running interest on partial drawn balances. Total project cost equals sum of capitalized hard cost plus other costs. Step 4, profit and profit margin computation. The example finishes with a margin of about 3.7%. This page is Lesson 12.11, the going-in IRR and implied risk premium activity. Going-in IRR is the discount rate at which year zero PV of projected cash flows equals maximum bid land price. The numbers shown derive an implied IRR of about 13%. Then the implied risk premium equals IRR minus risk-free rate. Here, roughly 9% excess return for taking on development risk. This page is the triad solutions for Lesson 12. Solution 1. Required profit equals 20% times the project cost of $42 million equals $8.4 million. Maximum land equals $60 million minus $42 million minus $8.4 million, which leaves $9.6 million for the land bid. Solution 2. Average loan $25 million times rate 7% times 1.5 years gives capitalized interest of $2.6 million. This page is step 4 of the capstone, profit and profit margin. Profit margin is calculated. Step 5. Solve for maximum land. The required profit determines how much land you can afford. Step 6. What would make this work? Higher rents, lower hard cost negotiation, longer cap rate compression. Step 7. Levered returns at stabilization, showing the actual achievable IRR after debt is layered on. The full development underwriting from project inception to exit. This page closes Module 13 on real options and sensitivity. The note says standard NPV often understates these projects because it ignores the value of weighting. Black-Scholes intuition, option value rises with volatility and time. Module 13 quiz, define sensitivity analysis. Identify 2 key risk drivers. Find the hurdle break-even, build versus delay, phase development, and what raises real option value. More volatility and longer decision windows. This page is part of the final exam. Capitalized interest computation, 28 million times 5.5% times 2.5 years gives the total. Then total project cost. Profit margin computation. Step 5. Solving for maximum land bid. Approximate iteration. Max land equals about 5 to 7 million, far below the 28 million assumed. Conclusion. Current cost and rent assumptions cannot support the developer's land bid. This page is final exam questions 37 through 40. 37 Quetzales. 3 operating expense items unique to a hot climate. HVAC servicing, generator fuel, and accelerated paint maintenance. 38 Quetzales. Valuing $5 million NOI at 2% growth over 5-year hold. Exit cap 8%. Sell costs 2.5%. 39 Quetzales. Why prefer NPV over IRR for ranking mutually exclusive projects? This page is more final exam questions, 13 through 15. DCR equals 4.8 divided by 2.925 equals 1.64. Pass. 13 Quetzales. List the 4 major space market indicators: vacancy rate, market rent, new construction quantity, absorption rate. 14 Quetzales. What does style purity mean in benchmarking? 15 Quetzales. Simplified financial feasibility analysis. Name 3 shortcomings. Single period snapshot. Ignores time value during construction. Uses 1 cap rate. This page is the formula master sheet. Time value of money block. Future value of annuity, present value of annuity, perpetuity, growing perpetuity. Then income and value, NOI, EGI, cap rate, vacancy rate, effective rent. Then investment metrics, NPV, IRR, holding period return, geometric time-weighted return, expected return, standard deviation, Sharpe ratio, and the price index. This single page is your reference card for any deal. This page closes the formula master sheet with capitalized interest, canonical opportunity cost of capital using the V over T component identity, and the portfolio formulas, expected return, portfolio variance, and covariance. End of course note. The unified course merged the structured Qatar edition with a full reference deep dive of returns, risk, modern portfolio theory, mortgage amortization, underwriting, the development capstone, and the 15-question self-check quiz. This page begins the appendix with the discounted cash flow full expansion. Value equals sum of cash flows divided by 1 plus r to the power t, each variable defined. Then lesson 1.5, the net present value formula, the difference between PV of future cash flows and the initial investment. Lesson 1.6, internal rate of return definition, the discount rate that sets NPV to 0. Section 2 begins income, yield, and valuation with lesson 2.1 NOI. This page covers lesson 2.6, the yield identity. Equity yield equals cap rate minus capex burden. Lesson 2.7, Gordon growth. Cap rate equals required return minus expected long-run growth rate. The constant growth identity. Then section 3, leverage and capital structure. Lesson 3.1, the foundational accounting identity. Assets equals liabilities plus owner's equity, the balance sheet identity. Liabilities equal debt. Owner's equity equals equity capital. This page covers lesson 3.6, the debt service coverage ratio definition. Lenders typically require DSCR between 1.2 and 1.25. Lesson 3.7, the level payment mortgage formula. Lesson 3.8, weighted average cost of capital. WACC equals equity weight times cost of equity plus debt weight times after-tax cost of debt. Then section 4, portfolio and performance attribution. Lesson 4.1, expected return as a probability-weighted sum. This page covers Sharpe ratio formula, excess return per unit of total risk. Lesson 4.6, two-asset portfolio variance, with the weight times sigma squared cross-term and correlation. Lesson 4.7, covariance, sigma I times sigma j times the correlation coefficient. Then section 5, inflation and real returns. The Fisher approximation, nominal rate equals real rate plus inflation, the simplest way to translate between nominal and real. This page covers limited partnership performance fees and hurdle returns. The promote equals general partner carry share. LP hurdle returns equal capital plus accrued preference. Then section 7, the Excel function quick reference. NPV, XNPV, XIRR, PMT, IPMT, PPMT, FV, PV, rate, E-date, sum product, if, and GenMax. Each function with its syntax and use case. Use these in any underwriting workbook. This final page covers lesson 8.4, the constant amortization mortgage principal payment. Amort equals PV divided by N, level principal each period. Then section 9, space market supply and absorption. Lesson 9.1, months supply equals vacant plus under construction divided by net annual absorption divided by 12. Lesson 9.2, months excess supply. Lesson 9.3, dynamic vacancy rate over time. With these formulas, you have everything you need to underwrite any deal end to end. Before we close, here's a bonus section. The main course covers most major concepts, but a few important formulas deserve their own dedicated explanation. So let's walk through every formula that wasn't named explicitly earlier. By the end of this section, you'll have full coverage of every formula in the master document. No gaps left. Gross rent multiplier, or GRM. The formula is purchase price divided by annual rent. It's the fastest valuation shortcut in real estate. A GRM of 8 means the property costs 8 years of rent. Lower GRM is cheaper. It ignores expenses and financing, so it's a screening tool, not a final valuation. Use it to quickly compare similar properties, then go deeper with cap rate and DCF. Yield on cost. The formula is stabilized NOI divided by total project cost. This is the development equivalent of cap rate. The spread between your yield on cost and the market exit cap rate is your developer profit margin. If the market cap rate is 6% and your yield on cost is 8%, you've created 200 basis points of value through development. Floor area ratio, or FAR. The formula is total floor area divided by site area. This is the zoning rule that determines how much building you can put on a piece of land. A FAR of 3 on a 10,000 square meter site allows up to 30,000 square meters of building. Higher FAR means more density allowed, which usually means higher land value. Cash on cash, or COC. The formula is NOI minus annual debt service, divided by equity invested. This is your year one cash yield on equity. Quick to compute, ignores time value of money, but it answers the simplest question: how much cash am I getting back per dollar I put in? A COC of 8% means 8 cents on every dollar of equity every year. Capital market line, or CML. This is the optimal frontier when a risk-free asset is available. You blend the risk-free asset with the tangency portfolio, the portfolio with the highest Sharpe ratio. Every point on the CML beats every point on the risky asset-only efficient frontier. It's the foundation of modern portfolio theory and one of the most important graphs in finance. Constant payment mortgage, or CPM. The formula is loan principal times interest rate divided by 1 minus 1 plus interest rate to the negative number of periods. This is the standard residential mortgage. Equal monthly payment for the entire term. Most of the early payment is interest, and most of the late payment is principal. The amortization curve is steep at the start and gentle at the end. Money-weighted return, or MWR. This is the IRR of all your investor cash flows. It captures your timing as an investor. If you put more money in just before a market drop, your MWR suffers, even if the asset itself performed fine. Time-weighted return measures the asset. Money-weighted return measures you. Both are essential for performance evaluation. Terminal value, or TV. The formula is the NOI in the year after your hold period, divided by the exit cap rate. This is the single biggest number in any DCF, and it usually accounts for 60 to 70% of total deal value. Even a small change in exit cap rate moves terminal value massively. Always sensitivity test exit cap rate carefully. Equity multiple, or EM. The formula is total cash distributions divided by total equity invested. It tells you how many times you got your money back. An EM of 2 means you doubled. An EM of 3 means you tripled. It doesn't tell you how long it took, but it gives you the absolute performance attribution. Active return equals selection plus allocation. Selection is your stock picking within each sector. Allocation is how you weighted the sectors themselves. Both are measured against a benchmark. A good manager has positive selection and positive allocation. A weak manager might pick good assets, but still underperform if their sector mix is wrong. Residual land value. The formula is stabilized value minus total cost minus required profit equals maximum bid for the land. This is how every developer underwrites a site acquisition. Solve backwards from your projected stabilized value. Deduct hard cost, soft cost, and the developer's required profit margin. What's left is the most you can pay for the land and still hit your target return. Pre-tax cash flow, or PTCF. The formula is NOI minus annual debt service. This is what hits the equity bank account before taxes. It's different from EBTCF, the equity before tax cash flow used in underwriting, which also subtracts capital improvements. PTCF is what investors see month to month. EBTCF is what banks check for covenant compliance. Month supply. The formula is vacant space plus space under construction divided by the net annual absorption rate divided by 12. This tells you how many months of demand the current vacancy and pipeline represent. Below 12 months means a tight market with rising rents. Above 24 means oversupply risk and concessions ahead. Months excess supply. The formula is vacant plus under construction minus the natural vacancy times total supply minus demolitions divided by absorption divided by 12. This isolates the supply that exceeds equilibrium. It is the leading indicator for falling rents and rising. Effective rent with abatement. The formula is asking rent times the lease length minus the free months divided by the lease length. This adjusts headline rent for free month concessions. A landlord offering 1 year free on a 10-year lease is effectively giving a 10% rent discount. Always compare deals on effective rent, not on the asking rent. The canonical opportunity cost of capital, the Geltner identity. The formula expresses the asset's present value as the unlevered V-side discount minus the debt-side D-side discount. This is the math behind the weighted average cost of capital. It cleanly separates the asset's return into the part earned by equity and the part absorbed by debt service. And that completes the full coverage. Every formula in the source document has now been explained, from the basic net operating income all the way to the canonical opportunity cost of capital identity. You have the complete real estate underwriting toolkit, ready to apply to any deal, residential, office, retail, industrial, or development. Good luck and happy investing. Final coverage patch. Even after the bonus section, a few more formulas in the master document deserve their own dedicated slide. Acronyms, partnership structure formulas, and a few specialized concepts. Let's close the gap completely. By the end of this section, every single formula in the document will have been named and explained. Holding period return, or HPR. The formula is income plus change in value, divided by the beginning value. This is the single period total return on a property. It equals income return plus capital return. Every more advanced return measure, time-weighted, money-weighted, IRR, builds on this simple foundation. Always know your HPR before computing anything else. Operating expenses, or OPEX. The total of property tax, insurance, repairs, management fees, utilities, and miscellaneous costs. Everything the property pays out each year to keep operating. Critically, OPEX excludes capital expenditure, debt service, and depreciation. Those are below the line. OPEX sits inside the calculation of NOI. Potential gross income, or PGI. The formula is total rentable area times market rent per unit. This is the top line of every pro forma. The income if every unit were full at market rent. Vacancy losses and concessions are subtracted from PGI to arrive at effective gross income, the EGI. Time-weighted return, or TWR. The formula is the geometric average of period returns. 1 plus R1 times 1 plus R2, all the way through the last period, taken to the 1 over n power minus 1. TWR strips out the timing of cash flows, used to compare assets independent of when investors put money in. Modified internal rate of return, or MRR. The formula is the future value of positive cash flows divided by the absolute present value of negative cash flows, taken to the 1 over n power minus 1. MGRR fixes the unrealistic assumption in standard IRR that intermediate cash flows are reinvested at the IRR itself. Instead, MARR reinvests at the WSCC. More conservative, more realistic. Balloon payment. This is the lump sum principal due at the end of an interest-only or partially amortizing loan. With an IO loan, you pay only interest each month. Then at maturity, you owe the full principal. The borrower must refinance, sell, or default. Every IO loan has a balloon decision point you must plan for. General partner and limited partner structure. Total equity equals GP plus LP capital. The GP runs the deal day-to-day and earns a promote, an extra share of profits above the hurdle. The LPs provide most of the capital and earn a preferred return first. This is the two-tier waterfall used in every private real estate fund. Site budget. The formula is land cost plus soft cost plus financing cost. These are the pre-construction line items in a development budget. Soft costs include design fees, permits, legal, and pre-development consulting. Financing cost is the interest reserved during construction. Get the site budget right before you sign anything. Construction loan and permanent loan. Two-stage development financing. Stage 1 is the construction loan, which funds the build at a higher floating rate. Stage 2 is the permanent loan, which refinances the construction loan at a lower fixed rate after the property reaches stabilization. The permanent loan is also called the takeout. Asset, equity, and debt components. The asset value splits between the equity component and the debt component. The total value equals equity component plus debt component. Each component has its own discount rate. Putting these together is exactly how the weighted average cost of capital, or WSCC, is derived. Occupancy rate. Simply 1 minus the vacancy rate. Always reported as a percentage. If vacancy is 7%, occupancy is 93%. Property managers track occupancy daily, since every percentage point of occupancy lost is rent revenue gone. The mirror image of vacancy, but used more often in operations reports. The canonical opportunity cost of capital, the Geltner identity. This is the formal name of the canonical OCC formula from Professor David Geltner's MIT real estate course. The asset's discount rate, capital are sub C, links to the equity side rate are sub V, and the debt side rate are sub D. It shows how the asset, equity, and debt sides reconcile mathematically. And that's it. 100% coverage achieved. Every formula in the master document has now been narrated and explained on its own dedicated slide. From the basic holding period return all the way through the Geltner canonical opportunity cost identity. You have the complete real estate underwriting toolkit. Nothing left out. Now go underwrite a deal.